Hi, good morning, everyone. I'll just wait another minute or so as everyone is filing into the webinar. Just wait, give the late joiners a minute or two just to jump on. All right, so I think we can kick off today's session. First of all, thank you very much for joining us today. My name is Chris Eddy, and I'm Head of Investments at 10X. The purpose of today's session is to take a look back over 2025, understand really what drove markets, how the portfolios performed, and then take a bit of a step back as we look out into the year ahead, into 2026 and beyond, to understand how we've positioned our portfolios, where we see some risks and where we see some opportunities. We are through pretty much January, through the first month of the year, and then you can already, if we go back and think about everything that's already happened this year, it's really got off to a busy start, quite a volatile start from sort of a news and geopolitical perspective. And from a South African perspective, we're really seeing strong asset class returns, which is always great as an investor who's looking to compound your real wealth over time. So when returns have been strong, it's always one feels a lot better, and you feel a lot more comfortable as your balance has grown, and that's something that you want to continue compounding through time. So if we look back over 2025, obviously we know from everything we went through with tariffs to geopolitical tensions, there was a continuous barrage of headlines throughout last year. But I think one of the big themes for 2025 was the fact that the dollar weakened quite significantly. Here we're showing the DXY index. It's effectively a basket of currency, of developed market currencies, and it shows kind of how the dollar performed against that basket. You can think of things like the euro, the pound, the yen. And what you can see against those developed market countries, the dollar depreciated in the region of about 11%. So quite a significant depreciation over the course of 2025. A lot of it was quite front-loaded and happened in the first quarter, but that persisted throughout the year. Now, we often, as South African-based investors and Rand-based investors, we really evaluate and often think of the Rand as a bit of a barometer for sentiment in South Africa. And I even yesterday I saw some news headlines coming across which said that the Rand had strengthened more than 25%, I think, from the lows around those Liberation Day tariff announcements, which is a significant move. So not only have we been in an environment of dollar weakness, which drove a lot of the early Rand strength, to the latter half of the year, we've seen kind of the Rand take over the reins as well, because there you can see kind of the dollar was sort of flat for the back half of last year. That was one of the big themes. And why is that important? Well, typically when the dollar is very strong, US markets and US assets tend to outperform. When the dollar is a lot weaker, you generally see assets around the rest of the world, emerging markets, commodities, tend to perform a lot stronger in a dollar environment. So here you can see effectively total returns to a number of different equity markets around the world, and we've converted those to rands. Now, the S&P 500 was up something like 17% in dollars last year. But given the rand strength, we can see it was only up about 3% for rand-based investors. Then there's this kind of bulk of many other markets all centering around sort of 12 to 17%, that you can see. The pink line is broad emerging markets. They were up about 17% in rands. When one looks at other developed markets and you exclude the US, so things like Europe, Japan, the UK, developed markets ex-US were also up about 16%. That's the lighter blue line. And the Chinese market was storming ahead through last year. And it was a little bit softer, I would say, in the fourth quarter. You could see it was tracking up with the JSE and then kind of sold off in the fourth quarter. But really, the JSE has been one of the standout performing markets last year in rand terms. You can see it was tracking emerging markets pretty much until about the fourth quarter. And then from the fourth quarter, really we saw the South African equity market kick on. And one of the main reasons for that have been some of the trends that we've been seeing in the commodity markets, more specifically the precious metals markets. And we know that from a South African perspective, some of our major exports are precious metals. There are effectively four main commodity exports. So it's gold, platinum, group metals, iron ore, and coal. And out of that, gold and platinum make up a large percentage. And here you can see I've really gone back really to the start of last year. And over the 12-month period over last year, you've had platinum, which was up something like 120%. Gold was up something like 65%. And that brings a significant windfall of hard currency into the South African economy. And equally, our largest import is crude, so Brent crude oil. And there you can see actually that kind of the crude market and the oil market was incredibly soft over 2025. So there's big disconnect between different parts of the commodity market. And why is that important for us? Well, we know that fuel prices are a major import into almost everything in the South African economy. So when you have oil prices much lower, that helps feed through into a big disinflationary effect. It keeps a lid on inflation. And that's really what we've seen. We've been through a very low inflation environment in South Africa. And when you see that your big exports are earning you lots of hard currency and you're not having to pay away much hard currency for your imports, it massively improves the terms of trade. And that is a big underpin for the South African rand as well. So not only does it help strengthen the rand, it helps keep a lid on inflation. And what we're going to start seeing, I think the next budget speech later next month is going to be very interesting. It's going to materially improve the fiscal situation in South Africa because the tax windfall and the tax revenue from much stronger commodity prices really help the government, one, have to avoid raising additional taxes, but two, also kind of keeps a lid on our debt trajectory. And the other aspect is that really what one starts to see is a lot of risk premium being priced out of South African assets. So provides a strong underpin for falling of rates in South Africa. Here you can see really what drove the South African stock market. So the JSE All Share was up 42% last year. The RESI, so the Resources Index, was up something like 144% last year. And that lifted the South African equity market and really saw the South African equity market being one of the standout markets around the world. Something that I think we haven't been accustomed to for quite a while. For the last sort of 10 to 15 years, we've just been seeing US equities being one of the best performing markets. And really there seems like there's been a bit of a leadership change here. The financial sector, so that's the SA focus part of the market, up 27, which is also a fantastic return, but it just pales in comparison to what we've seen on the resource side. And then the industrials up also 19%. So a fantastic year to be invested in the South African equity market. Really strong returns. And here you can see I mentioned the terms of trade earlier, and that's kind of looks at our exports versus our imports. And that's the orange line. And there you can see the terms of trade have improved materially through 2025. And the interesting observation here I've looked at, it's called the South African Real Effective Exchange Rate. It's basically a broad basket of different currencies versus the rand. So it gives you kind of the average strength of the rand after inflation. And you can see that it kind of moves and rhymes with our terms of trade. And so what we've seen now is this big upward move in our terms of trade is really what's providing a strong underpin for the rand. So going forward, if we kind of see commodity prices staying where they are, you're probably going to find that the rand is going to be a lot more resilient, not because of anything to do with the local economy or the local political environment, but completely based on what's happening in the global picture and the underpin that we've seen for precious metals. So the rand will probably continue being a bit more resilient, even though we've seen it strengthen really pretty materially over the last 12 months. And I mentioned inflation. The chart on the left-hand side here really shows you how inflation earlier this year actually really collapsed below that 3% target. We saw the Reserve Bank come out quite strongly. So if you look at this chart over here, that dip below the 3%, it was in March 2025. Inflation came in at about 2.7%. And the Reserve Bank has been, for a long period of time, looking to reshift the inflation target from the midpoint of the 3 to 6 band, so from 4.5 down to 3%. And when inflation was already down at 3%, it meant that, you know what, they don't have to keep Reserve Bank repo rates and interest rates higher to get inflation down. They can kind of make the move, and there shouldn't be much pain from an interest rate perspective. So that's why they came out really hard. And then obviously that was subsequently concurred by the Ministry of Finance, and we shifted to the new inflation target. So the chart on the right-hand side just shows you South African bond yields. So we can see for a number of years first the inflationary environment, and then when there was a lot of concern around the South African election 18 months ago, South African 10-year bond yields were above 12%. We had a positive election outcome, and bond yields fell from above 12% to something like 10%. That was kind of the first big move in bonds, and we saw last year bonds really deliver equity-like returns. In 2024. And then this next move down, we saw Liberation Day, bond yields backed up to about 10.5%. And then they've gone from 10.5% all the way close down to 8%, which is another kind of 2.5% fall in bond yields. And that was really off the back of low inflation and the reset down to the new inflation target. And that's meant that South African bonds have really delivered equity-like returns for another year. So really, as you look across the board, asset class returns for South African assets have been standout performers. So when we look at different asset classes, we tend to group them into two buckets: growth asset classes and defensive asset classes. Growth asset classes are generally where you find most of your high long-term returns coming from things like equities, property, but they're a lot more volatile over the short term, whereas defensive assets are typically a lot more stable over the shorter term, but can give you typically give you much lower long-term returns. And here you can see, wherever you look, it has really been the South African asset classes that have been outperforming over the last 1 year. SA equity at 42, SA property at 30. You got to SA bonds 24% from South African bonds, which is a defensive asset class, is a fantastic return. Inflation linkers giving you about 15, again, a great return. Even cash at 7.5%, which I think probably a lot of people would scoff at because we've been in a really high return environment for the last 5 years. When you think that inflation's coming in at 3.5, that's a real return of 4, which over the last kind of 10 years is what SA equity delivered you. So it's really a great return environment. And what we've seen is that stronger rand being quite a big headwind to offshore assets. Emerging market equities typically still delivered quite pleasing returns in rands, but developed market equities, which have the bulk of their exposure invested in the S&P 500, which faced dollar headwind and it faced a number of other challenges through the year, was actually kind of the laggard, and what we're seeing is this sort of leadership change from developed markets and from US equities into other parts of the world on the back of a weaker dollar. And those strong rand returns were obviously a headwind to global defensive assets like global bonds and cash, which in dollars would deliver quite a steady return, but because the rand is quite volatile, it took a bit of a shine off the performance of those asset classes. So when we put that together and we think about how the different portfolios performed, we have looked here at the range of Regulation 28 portfolios over 1, 5, 10, and 15 years, going from the 10x Your Future Fund, which is the high equity balance fund. It's typically the portfolio that most investors with a long-term time horizon, certainly all investors in the pre-retirement space, so if you have an RA or a preservation fund, would typically be invested in. The moderate fund is slightly lower risk. The defensive fund is even more lower risk. And then the income fund is purely a fixed income portfolio with no growth assets in it. And what you can see in environments where returns are very strong, you've got this downward sloping trajectory from highest risk to lowest risk, where highest risk has been giving you the highest return. And as you stretch that time horizon out, you pretty consistently see that over the longer term, if you can hold higher risk portfolios through periods of shorter term volatility, you are always rewarded with much higher longer term returns. So over the last 15 years, the 10x Your Future portfolio has delivered 11.3%. Inflation's come in at 5%. So from a real return perspective, that's around CPI plus about 6.5% return to 10x Your Future, which really shows you the value to holding a well-diversified high-growth portfolio through the cycle over the longer term. The income fund was only launched 3 years ago, and that's why you'll see a gap on over 5, 10, and 15 years. But something to point out is how sort of capped SA inflation has been. So over a 1-year basis, the 10x Your Future Fund has delivered something like inflation plus 13%, which again is much higher than you would expect from a portfolio like this over the long term, but typically some of the volatility that we see over the shorter term. On that, I mean, on average, and this isn't 10x specific, this is kind of across the industry, a high equity balance fund typically on average through different market cycles gives you about inflation plus 5 to 6. I mean, that's what we've sort of done, just above inflation plus 6 over the last 15 years. But we know that markets are pretty cyclical. And if we look at the last 5 years, one can see the 10x Your Future Fund has given you a fantastic return of 13.5% per annum for the last 5 years. And inflation's been at effectively 5%. So that's real returns of 8.5%. Over the last 5 years, which is much higher than you typically would expect through the cycle. So I think what investors probably need to manage their expectations as we look ahead and we look forward to understand that it's been a fantastic time to be invested in markets over the last 5 years, but maybe our expectations shouldn't necessarily be inflation plus 8 to 9 for the next 5 years, because we know that markets are cyclical and periods of higher returns typically tend to be followed by periods of lower returns. And that really comes through in that 10-year number that we're seeing. Some of you today here will invest in living annuity portfolios. Living annuitants don't have to invest in Regulation 28 portfolios. They can invest in portfolios that have more offshore exposure. And so for those clients in living annuity products, we have created and we offer not only a global equity portfolio, which is the MSCI World Feeder Fund. We also have an international high equity and an international medium equity. These portfolios typically have everything from about 60% offshore all the way up to about 100% offshore, but more well diversified across global asset classes than a more concentrated South African portfolio. I think what's important to understand is you obviously are taking on more currency risk here. That can work for you sometimes, as we've seen in the years before 2025. But in 2025, which was a year where the rand strengthened quite significantly, the stronger rand becomes a bit of a headwind to those international portfolios. But despite that, the international high equity has delivered inflation plus 11.5, and inflation's come in at 3.5. So again, we always like to think about the world through the lens of real returns. So even that international high equity has given you a real return of 8% above inflation last year. But as you stretch that time horizon out, the last 5 years and the last 10 years have been much better environments to be invested offshore in global equities. That's been the story of the last 10 to 15 years, and you can really see that through this performance chart. So that's kind of, I think, where we are sitting. We're about 20 minutes in. I'm going to spend sort of the next 10 to 15 minutes going through one or two big themes that we're seeing from a market perspective and how we have positioned the 10x Your Future portfolio and the asset allocation views that we have in our funds, to give you a little bit of a sense of where we see some risks and some considerations. Please do use the Q&A feature that we have here, because when I finish going through the short outlook that we've put together, we should have some more time for questions. So please feel free to pop them in the Q&A box, and I will get to those in the last sort of 20 minutes or so. So as we look out ahead into 2026, I think one question on a lot of investors' minds, given what we've seen, given the dollar weakness, given that we've seen the rest of the world equities, emerging markets, developed markets, ex-US and South African equities perform much stronger than US equities. It's something we haven't been accustomed to for the last 15 years. So I think the question many investors are asking is this just a bit of a blip in a longer-term trend that we've been used to, or is there maybe a bit of a turn in the cycle here? Now, what's quite interesting, if we look at this over the very long term, now this isn't looking at South Africa, this is just looking at the performance between US equities and developed market equities outside the US. I mean, the first observation from this chart going back to 1969 is that markets move in very long cycles. And what you can see here, really from about 1970 to the late 80s, the rest of the world massively outperformed US equities. For 18 years, they delivered more than 8% outperformance per annum. Why? You saw kind of the bursting of the Nifty 50 bubble in the US at that point in time, and the really strong returns from the Japanese equity market when Japan was going to take over the world in the late 80s and 90s. Then that Japanese equity bubble burst, and we saw US leadership take over, and US equity markets outperformed for more than 13 years, delivering more than 11% stronger return than the rest of the world for a full 13 years. And then we saw that culminate with the bursting of the dot-com bubble. And then we saw China enter the WTO and the commodity bull run of the 2000s. SA equities were really the place to be. Emerging markets performed very strongly. And the rest of the world outperformed the US for a full 8 years by more than 7% a year. Now, that was actually the last time US equities experienced a lost decade. And I think for investors who have just been looking at markets for the last 10 to 15 years, probably can't imagine an environment where US equities deliver zero real returns for a full decade. But it actually wasn't so long ago. It was the bursting of the last tech bubble. And since the lows, really kind of from the global financial crisis, we then had the invention of kind of QE, zero interest rate policy, and the emergence of many of these tech businesses. For the last 15 years, it's been a one-way train, and the US equities have really been the only game in town, outperforming by close to 8% a year for the last 15 years. It's been a fantastic time to be invested in US equities. Now, last year was pretty much the first year that we saw significant outperformance of the rest of the world. And so the big question is this just a blip in US outperformance, or are these potentially the first cracks of US exceptionalism that we're starting to see? Now, a lot of people throw US exceptionalism around. That's not to say that US companies aren't more innovative or their capital allocation isn't better. It really is. It's just to say, should they be and continually earn a materially more elevated valuation versus the rest of the world? And that remains to be seen. But I think this ties very much into that US versus ex-US performance. This is the long-term chart of the US dollar strength and weakness. Again, it's against a basket of currencies in real terms. And what's interesting is you can see the peak to trough drawdowns are also very cyclical. And you've seen kind of, again, in the 70s, a 33% drawdown. In the 80s to the early 90s, 36% drawdown. Then it was dollar strength again. During the 2000s, the dollar sold off 26%. And then it's been dollar strength again, really, for the last 15 years, except for last year, we really saw kind of that dollar weakness. And the question is, again, are we starting to see trends between these cycles emerge here? And the question many people are asking is, we've seen such dollar weakness, but actually in the context of the longer term, it is pretty much a blip. And you had to say, if you had to go kind of back to where a more reasonable fair value for the dollar is, there's still kind of 10 to 15% downside from a dollar perspective. And the interesting thing is that you never really see the dollar sit at the midpoint around that fair value. It typically always undershoots. And those cycles, we've seen sort of drawdowns ranging from 26 to 36%. So dollar still remains quite overvalued, quite expensive in a global context, despite the softer returns to dollars we saw last year. And here you can see, we're just overlaying those two, the dollar strength and weakness and US outperformance versus the rest of the world. And you can see that they are very correlated. So one can extrapolate from that. If we expect to see continued dollar weakness, don't be surprised if you see US equities lagging the rest of the world, lagging Europe, lagging Japan, lagging emerging markets like South Africa. The thing to think about as an investor today is understanding how your money is invested and understanding where your money is invested. What we're showing here is the composition of the MSCI World Index over time. And what you can see is the weightings of different countries and different regions fluctuate over time. If we go back to sort of 2010, the global financial crisis, you can see that the weight of US equities in MSCI World was just below 50%. We're now sitting closer to 75% of MSCI World, broad developed markets, sitting in US equities at a time when US equities have massively outperformed the rest of the world. But there certainly are signs that the cycle might be turning going forward. And it's important to understand, if you have a highly concentrated exposure to one specific bet, the risk that you're taking. So in an environment like now, where we're seeing a lot of uncertainty, where we are seeing big disconnects, where US equities are much more expensive than the rest of the world, the dollar's much more expensive than many other currencies, it's important to ensure that you're well diversified across a wide spread of assets so that you don't embed a one-way bet ultimately in the portfolio. This just shows you that kind of disconnect from a valuation perspective. It's the CAPE ratio. Won't spend too much time here, but you can basically see how much higher the purple line is than the lighter blue line, which is the long-term average. So US equities are pretty much close to the most expensive they've been going back on record, whereas European equities are much more closer to that kind of straight black line. So on average, they are slightly elevated from a valuation perspective, but certainly not in bubble-like territory. And why does that matter? Well, when you invest in markets that are very stretched from a valuation perspective and elevated from a valuation perspective, history shows us that your future and forward returns over the next 5 to 10 years typically tend to be much, much softer. Whereas if you invest in markets when they are much cheaper, what you see is that forward returns typically tend to be much stronger going forward. Now, from a South African perspective, I don't think we cannot not touch on what's been happening in precious metals. This chart I updated yesterday just to kind of roll forward really how precious metals have pretty much gone parabolic. There's no other way to describe it over the last kind of 3 months. I mean, since the start of 2025 to when was that? That was kind of the 28th of January. Gold is up more than 100%. Platinum's up almost 200%, and silver's up almost 300%, which are incredible moves when one thinks about different asset classes. And this is such a massive positive for South Africa. That's got nothing to do with the South African economy. It's got nothing to do with the South African political situation. It's got everything to do with the global environment, but it's a big win for South Africa, not only for the South African economy, as I've previously covered, but also for the South African equity market. Because the interesting thing is, compared to global markets where miners and precious metal companies make up somewhere in the region of 1% to 2%, the size and the growth of gold and platinum shares on the JSE has just gone parabolic. Now, that's fantastic when we see the strong returns that they've driven into SA equity markets. But where we're sitting now, the gold and platinum shares make up about a third of the total equity exposure in South Africa. And you can see that's gone up from about, just kind of eyeballing this at the start of 2025, it was around 10%. It's now 30%. If you go back 10 years ago, it was around 2-3%. So there's significant concentration in SA equities today to an asset class that's currently going parabolic. Now, clearly, that introduces a wide range of outcomes going forward. This thing continues going through the roof. We're going to see really strong returns from SA equities. The miners are going to print really strong earnings and have very high dividends that they'll pay investors. However, if we see that kind of sharp uptick really kind of come collapsing down, which is often what you see when you see these kind of parabolic moves up, that obviously presents a risk for investors in South African equity. So certainly something to bear in mind as we look to the returns from SA equities going forward. This chart really just shows you, it compares the earnings yield on equities to the real yield on South African bonds. It's a measure to say, from this point, looking forward, equities should always give you more returns than bonds. But where is the market from a valuation perspective currently pricing that additional premium? And what you can see is that that premium has pretty much collapsed over the last 5 years from the long-term average of about 4 down to the region of close to 0, given the strong run-up that we've seen in the cyclical mining sector. And compared to the fact that you can still go today and invest in South African inflation-linked bonds and earn inflation plus 4 to 4.5, which is a fantastic outcome when you're thinking about generating income for yourself going forward. So what that means is that as investors, we've seen really strong returns through the rearview mirror, but we're not being compensated that much from this point for taking on risk going forward. And it's really a picture actually we see across equity markets all around the world, where that same excess measure has really been sort of collapsing over the last 5 years. And what this is just showing is that that excess is much narrower in the US, where there's still kind of a bit more of an excess return in European markets, and maybe further argues for ensuring that you're well diversified globally, not just concentrated in US equities. So that's kind of a couple of points to think about. I mean, in summarizing those, what are the key takeaways? We've gone through an environment of exceptionally strong returns over the last 5 years. We know that markets are cyclical. What we're seeing is that risk premiums have compressed everywhere, really across growth assets. And so one maybe needs to think about, if my objective is to deliver inflation-beating returns, inflation +3, +4, +5, +6, can I get those in a relatively low-risk way, or do I have to take lots of risk to get those? And today, given the relatively high yields that we're seeing on bonds, you don't have to take a lot of risk to deliver inflation-beating and decent inflation-beating returns. And actually, given where valuations are in equities, one needs to tread with caution looking forward, because we know that the last 5 years have been really strong returns, primarily driven by an expansion in valuation. And the other takeaway is just understand what risk is embedded in your portfolio. How much exposure do you have to highly concentrated US equity markets? Certainly, as we see that there has what certainly on the surface appears to be a bit of a shift in regime to a weaker dollar environment, which would certainly provide support for the rest of the world, outperforming US, which is something we haven't seen over the last 15 years. So what does that mean for how we position and build our portfolios? This chart just looks at where we are today and looks out over the next 5 to 10 years. The blue bars are the types of returns we can expect across a range of different asset classes from today over the next 5 years. They're real returns, so they're after inflation. And the pink bars are really what asset classes have delivered historically over long-term cycles. And what you can see for this is over the very long term, bonds and cash have given you about inflation, between inflation +1 to inflation +2. Equities have given you about inflation +7 in SA and US and developed markets, a little bit lower in emerging and ex-US markets. But as we sit today, all the defensive asset classes, so that's bonds and cash, wherever you're looking, are delivering returns much higher than what they have historically. And that makes sense because we've been through an environment where real rates across the world have backed up from the lows 5 years ago during COVID. And equity markets, wherever you look, are either fairish value to expensive. And the prospective returns are certainly looking much lower than what we've seen over the last 5 years, over the last 10 years, with the big standout being US equities, which looks from a valuation perspective like it's positioned to deliver another decade of real returns around zero, so potentially another lost decade. So what does that mean? If defensive asset classes are offering much better value, well, we've got an overweight to defensive asset classes today. Why? Because we can deliver the outcome that we're looking to deliver for clients with much lower risk. Inflation beating returns over 2, 3, 4, 5% from defensive assets is a fantastic opportunity as investors, while we have a slightly lower allocation to growth assets. And within our growth asset exposure, we are primarily underweight developed market equities and primarily underweight S&P 500 US equities, with an overweight to emerging markets, to China, and to developed markets ex-US. And from our perspective, I think one key takeaway here, and we always think about this through the lens of what we think matters for clients at the end of the day, which is the ability to compound their real returns through time, over time. And if we have an environment where, let's say, we have a blow-off top in equities over the next 12 months, how can one expect your 10x, your future fund portfolio to perform? Well, you can expect great real returns like we've seen over the last 12 months, because growth assets will be rallying, so returns well ahead of inflation. But it could be slightly softer relative to what you would get if you invested 100% in equities. Whereas if markets roll over, if we have a bit of a valuation re-rating, if we see some of those risk premiums widen for whatever reason, you'll typically find that this portfolio is well positioned to continue delivering real returns across a range of scenarios, not just any one scenario. And for us, that's really important to ensure that clients can compound their wealth over multiple years, whether that's saving for retirement or whether that's paying themselves an income in retirement. So that's kind of everything I think that we wanted to cover. I see that there are a couple of questions that have come through. Please fire any more questions through if you do have anything else that you would like to ask, but I will start going through these. Okay, so I think before I jump into answer some of these questions, I must say that anything here, please don't construe or take as financial advice. I mean, you've got your own specific situation. I can't really tell you which portfolio you should be invested in or which portfolio you shouldn't be invested in, because I see there are a couple of queries like that coming through. But I can talk more generally around that. And there are a few questions saying, well, what we've seen is the international portfolios have taken quite a significant hit over the last couple of months. Look, that is to be expected when you're investing in a portfolio that has very little rand exposure and the rand rallies quite significantly. To say where to from here, look, I don't have a crystal ball for what the next 3 to 6 to 12 months hold. For us, our starting point is always ensuring that you're well diversified so that you can deliver the right outcome across a range of different scenarios. To answer that question more specifically, if I had to guess, if we see commodity prices continuing to remain elevated, getting stronger, good chance the rand's going to continue strengthen given the fundamental underpin that stronger commodities have on the South African economy and the rand. However, if we see those commodity prices kind of sell off from these really heady and elevated levels where we've really seen it go parabolic, well, there's a good chance in that environment that the rand will come under pressure because that tailwind will be moved away. But unfortunately, I don't have a crystal ball to tell you exactly what's going to happen to the commodity market at the moment, and I don't think anyone can. Looking through here, there are some questions coming through. I remember a webinar a year ago and did not hear anything about the possible impact of the value of the rand. As I'm hearing now, was this completely unexpected? What I remember is a cautious approach to the S&P. Yeah, that's right. I mean, we've been talking about this for the last 12 to 18 months, that the big call in investors' portfolios and what the position that's structurally embedded is this big overweight to S&P 500 and US equities. I would say the big change from a rand perspective has really been over the last 6 months, off the back of what's been happening with commodities. I think at times like these, you don't want to make knee-jerk reactions once you've already experienced soft or poor returns, because you know that markets are cyclical. Selling at kind of a relative low or a soft point is typically the way that one destroys value over time, continuously switching a portfolio. You need to understand what the right mix of assets for your specific situation is and understand what the risks of that approach is. If you take a portfolio which has lots of offshore exposure, well, your risk is that the rand strengthens quite materially and you potentially put at risk. So what other sort of rand assets or liabilities do you have outside of your living annuity? If you take a portfolio that's very defensively positioned, you might sleep quite well at night, but and certainly if markets sell off, you'll sleep quite well at night. But over the long term, your longer term returns are going to be much lower than if you invest in a higher growth portfolio and consistently hold that through time. So it's always important to take a step back. The first question you should be asking yourself is, do I actually understand? Do I know how I'm invested? Do I know what my exposures are? And then take that back and understand what your goal is, what you're looking to achieve, what your outcome is, and see whether those are aligned or not. I know can always reach out to our team here and have a chat with them, and they'd be happy to help you. There was a question here that's saying, hi, are your charts showing growth before or after fees are deducted? So here the returns are net of all trading costs and costs around running the fund. But for our retail clients, we typically apply a fee scale based on the size of your assets. If you're in a RA, a preservation fund, a living annuity, and because those fees are different per client, it's very challenging to show like one net of fee return. So just know that here you need to apply your specific fee scale that's applied on the living annuity product to understand what type of net returns in your specific scenario you'll have. There's a great question here. I may have missed something, but what is the reason for dollar weakness? Are dollar-based assets being disposed of worldwide? Will this weakness not affect our returns over the longer term? Now, there are a number of reasons around why we're seeing dollar weakness. The first, before we get into some of like the more macro events that have sort of happened over the last 12 months, I want to go back to this one chart that I showed at the beginning, where we looked at from a valuation perspective where the dollar was. The dollar was very weak in 2011, and consistently from that weak level in 2011 has got stronger and stronger and stronger and stronger. And relative to its longer term fair value, which is that sort of dotted line, if you think about it through the world of PPP or inflation differentials, you can see that the dollar was very stretched. So from a fundamental perspective, you've got a very expensive currency. So the starting point means that it's difficult for the dollar to appreciate significantly from that very elevated level. Then you need to overlay two things. One, what we've seen over the last year is we've seen that US central bank has started to cut interest rates quite aggressively. It's happened over the last 18 months. It started in August 24, and we saw a couple more interest rate cuts over the last 12 months. And what that has meant, it's meant that the interest rate differential between the US, the real interest rate differential between the US and the rest of the world, has actually been narrowing somewhat. Because what you saw in the US in the post-COVID inflation boom is that the US actually hiked interest rates somewhat more aggressively than the rest of the world. And that supported a lot of the dollar strength. So if we're seeing these interest rates cuts coming through, that unwinds some of the support around those interest rate differentials, and is one of the reasons to see dollar weakness. I think the big other one is really what we saw also from like a US policy perspective in terms of some of the tariff announcements and kind of this specific need to try narrow the trade deficit, the current account deficit. I mean, it's quite mechanical, but if you think what happens, the US is the biggest importer in the world. To import, it sends dollars to the rest of the world. Those dollars have typically found their way being recycled and invested back into US assets, which has provided an underpin for the dollar. Now, a couple of things happened. There was the confiscation of Russian treasuries when the war broke out, which is one reason why global central banks are looking to diversify their reserves potentially away from US treasuries, a dollar asset. And then the other thing is kind of if weaponization of trade has happened, there's potentially kind of a risk around that is maybe the weaponization of capital. The US has it's called a net international investment position, where it's basically the kind of the debtor to the rest of the world, and where the rest of the world has invested a lot of money in the US. And if the rest of the world says, you know what, the US has shut their doors to our trade, maybe we need to think about where we're investing US assets, and there's kind of either a repatriation of those assets or one reduces their exposure to the dollar. And there are a couple of other things to think about as well, but it's primarily around the starting point being very expensive, narrowing interest rate differentials, and then some of the more sort of geopolitical concerns that we've seen over the last 12 months. There's a question here. It says, do you think staying in the 10x Your Future fund with the US dollar dropping will continue delivering to deliver returns higher than all the other portfolios? I mean, it's a good question. There are a couple of considerations there. On average, what I would say is if we see the dollar continuing to weaken, the 10x Your Future fund should deliver much stronger returns than the international portfolios, purely from a currency perspective. But it will probably also deliver stronger returns than the more defensive portfolios like the moderate and the defensive portfolio, because in an environment where the dollar continues weakening, there's probably a strong underpin for support for emerging market equities, South African equities, commodities, which the 10x Your Future portfolio is well positioned to deliver on. So those are some thoughts in that type of scenario. Do you have a portfolio that differentiates between US and non-US offshore exposure? We don't have an explicit portfolio that does that outright. Our global equity positioning in the 10x Your Future portfolio is tilted to global equities outside of the US, but there's no standalone choice. Please cover in which equity markets high international equity portfolio is invested. What is the exposure concentrated in US equity markets? Just given the nature of international equity portfolios, you are more invested in markets like MSCI World broad. The point of those portfolios is to get broad global diversification. One of the best ways of doing that is through kind of global indices. So there is a bit of a tilt away from US, but there is some US equity market exposure in those international portfolios. Did I understand that you're comfortable with income funds are still a sound investment, notwithstanding the last 6-month performance major that would include SA government bonds? Look, they are not the slam dunk that they were 12 to 18 months ago when you had real yields on nominal bonds in the region of 7-8%. But the interesting thing is the rally in government bonds up until the last 2-3 weeks has purely been the compression in government bond yields for the compensation of inflation risk. What's called the real yield, so the return sort of above inflation, which really represents a lot of South African risk, has stayed pretty kind of elevated and pretty static around inflation plus 4. So for a very conservative investor who doesn't have big drawdown requirements or doesn't have significant need to compound growth asset returns over the long term, it still remains a good investment option. But just know that you probably shouldn't expect equity-like returns from it going forward, but it does give you a much smoother path. I'm just cognizant of time. I see we've got a couple more minutes left here. There's a question that says, my kid's TFSA is invested in MSCI World Index Feeder and the top 60 SA equity index fund. Do you think I suggest that I add more funds to diversify? Do you think these two are sufficient? I think it's a great split, which gives you returns in a range of different scenarios, which is how we like thinking about the world. We don't think that taking one-way bets is a good thing to do because it comes with a lot of path dependency, and often people from an emotional perspective don't often remain invested through the fullness of time to benefit from long-term returns. Because if you just bet on one thing and you go through a period of cyclical underperformance, that is typically when you question your investment and often when you sell out of an investment, and that's the worst time to do it because you tend to lock in your losses at that point. So having exposure to SA equity as well as global equity, given what we've seen, I think is a good approach to diversification. Lots of questions around the rand dollar. We've spoken quite a lot about that. As I said, I think the key there is really what happens with commodities going forward. Trying to see if there's anything else here. I see there are a couple of questions around the acquisition by 10x from sort of Old Mutual. I'll just cover that off quickly because I think it's an important point just to mention. There is no change to our investment philosophy. There's no change to our branding. We're a separate business. We're a separate standalone business with the same management team, the same team at the helm, and exactly the same investment process. So there should be no concerns about hikes in fees or anything along those lines. If anything, having a long-term anchor shareholder like that potentially over the long term might even see opportunities for us to lower our fees sooner than we would raise our fees. So I don't think as investors you need to be concerned about our value proposition changing at all. We've really stuck to our knitting over the last 15 to 18 years, and that we're going to continue to do that, really trying to build a product that's simple and that really stacks the odds of success and increases the probability of you being able to reach your investment goals is really key for us. What I will say, maybe just to finalize and in finishing, what we try to do, we've got, and I'll be the first to say this, we don't have a crystal ball that tells us what the next 3 to 6 to 12 months may hold. Markets are very volatile. The environment's very volatile. What we try to do is we try and look through the cycle to understand where we're being compensated for taking on risk and try improve the probability of you compounding your real returns through the fullness of time. So in volatile environments, it's important not to make knee-jerk reactions. It's good to step back, understand where you invested, understand what your outcomes and your objectives are, and whether your investment portfolio is correctly aligned to what you are wanting to achieve from your own personal perspective. And if those two are aligned and you're well diversified, it's often best to just stay put and let those returns compound over the longer term. If there's a disconnect between what your objective is and how your portfolio is invested, that might be a time to kind of reevaluate. But I would certainly caution against knee-jerk reactions, especially when markets and the rand and everything moves very, very quickly. So all of the best for the year ahead for 2026. It's certainly going to be an interesting one. I think it started off with a great positive backdrop for South Africa, for the South African economy and for South African markets, given what's happened to commodities. Long may it continue. And thank you very much for joining us today. Thank you for your engagement and your questions. And if you do have any questions about what we've covered today or anything else, please don't hesitate to reach out to the team, and we'll certainly spend some time taking you through that and answering your questions. So that's all for today. Thank you very much. And until we get to spend some time again in future, if I didn't manage to get to your questions, please send them through and someone in the team will be able to answer them for you as well. But on that note, thank you very much. Cheers. Bye.